Good morning all. I am Dr. Taru Maheshwari from IPEM 𝓜𝓸𝓻𝓮 Today we will discuss about an introduction about the financial management. So when we talk about the financial management, before going ahead, we must know about what finance is. So basically finance is the lifeblood of any organization. And when we talk about its types, it consists of the personal finance, corporate finance, and corporate finance include trading and manufacturing concern. Then it leads to next is FIIs, and the next type is public finance and IFM. So, as we all know that it is the lifeblood of any organization, all the marketing activities or the HR activities revolve around this. And the personal finance is the finance which is related to the people. And when we talk about the day-to-day running of the business, or when we say that whatever the saving or the investment or of a person is, it all comes under personal finance. Now there is a very emerging area that is called as behavioral finance. It is an extension of your personal finance where the behavior also depicts about the need of the finance. The second type of finance is the corporate finance. So corporate finance is related with the funds management by the companies. Companies can be a trading concern, company can be a manufacturing concern. When we talk about the trading concern, it is just the buying and selling of the product. And in manufacturing concern, the companies produced the goods. So both have the area to manage the finance, but the scope is different. In the trading concern, the main is the profit margin because there is no production and no control on the cost of goods. But when we talk about the manufacturing concern, the major area to control is the cost of the production and have to have maximum sales price or the profit margin, we could say. So when we talk about the company's finance, it is related with the management of the company's funds. Next is financial institutional investment. When the financial institutions invest in either in the companies, or you can say they also invest on the public shares or the bonds. So this is also one area where the financial institutions do the investment across the boundaries. So this is the another area where the companies use to manage finance. When we talk about the public finance, it is mostly related with the public, and the government and the public are the major particulars which are involved in that. And in public finance, the government collect the taxes from the payers and invest for the development of public. So this is the public finance. Again, the management of funds is also required in public finance. In the international financial management, globalization is there. So here the funds are moved in and out of the national across boundaries, and the management of fund is needed. Here we can go by the letter of credit is there, and the ask and bid price are persistent in the market. In IFM, ADRs and GDRs are used. So all these are related with the financial management. So when we talk about the finance, there can be a personal finance, there can be corporate finance, there can be public finance, and also the international finance. It is all about finance. The next step is the financial management. So what is financial management is? Financial management is the management of funds Management of funds is the flow of funds. It is the procurement of funds and the utilization of funds in the most economic and effective manner to generate a maximum return from the investment and to have the minimum cost of capital is the basic concern of financial management. Now, coming to the scope and the importance of the managerial functions of the finance, we could say that the first function is the estimating financial requirement. Here, the first function is the how much the funds the company needs for running of its business. What should be the capital structure of the business, and what is the total capital which the company needs for running of the business is the first concern, that is estimating the financial requirement. Moreover, what is the total long-term and the short-term capital which is required by the companies, it is the another important area, or we can say that it is the scope or the importance or the managerial function of finance. The second is the investment decision, that is the capital budgeting decisions and the working capital decision. Capital budgeting decision is the long-term investment and where the company needs for long-term, and we can say that more than 5 years, because the company has a constraint of funds and have various long-term investment proposals. So where the company has to invest, it depends upon the investment decision. For investment decision, we have to use various techniques like NPV, IRR, payback method. We all use these techniques for estimating capital budgeting. And moreover, for the short running of the business, we also need to manage the inventory, receivables, and the cash. So from the cash, the inventory is purchased, and after making it processed, it is converted into finished goods. And then when sale is done, then there is a receivable management. So all these come under the working capital and the operating cycle, which the company needs to manage. This is the another concern area of financial management. Next, coming to the financial decision, that is the capital structure decision, we could say. So the company has to include in its capital structure that capital structure where the return is maximum and the cost is minimum. So whenever we go by the funds selection, this is the major concern. Simultaneously, the company should be a levered firm. That is, that company have debt and equity into consideration, but it is also a concern that companies should not be so much levered. There should be a balance between taking of the debentures and the equity into consideration. The next decision which the company should take while managing the funds is, while managing the finance is the dividend decision. Means how much company has to pay to its particular shareholders. That is another concern area. So if company has major investment and company can get more return rather than or it is greater than the cost of capital, then company should have to invest in the long-term projects rather than distributing the dividend. But if in case of vice versa, if RA is less than RC, company should distribute dividend. Moreover, when the company take dividend decision, company should focus upon whether it has to distribute the bonus shares or the cash shares, and that depends upon how much cash the company has. Next decision which the company takes is the capital structure managing. So how the management is done, it is just the cycling of the funds, means to take funds and then distribute dividend, and managing capital structure to take into consideration the less cost of capital and the maximum profit from that capital structure or the capital which is taken by the company. Next is the management of cash. So cash should not be in scarcity and should not be in abundance. This is the another concern area, because if company has more liquidity or the more profitability, then if company has more liquidity, then profitability will suffer. If company has more profitability, then liquidity will suffer. So there should be a balance between profitability and liquidity. Because if company has a crunch in the liquidity, company has to bear high cost of capital. Right? And if company has invested all the things, then company have haphazard financing. The next area is the negotiation. Financial manager has to negotiate while selling the products, as well as while raising the fund, or while negotiating with the angel brokers. This is another area. Next, coming to the financial control is whatever is budgeted. That, let's suppose company has said that company will issue that much equity share, and the market value of that share should be 25, 26 or 27 in the coming years. And if the company is not getting the actual situation as budgeted, then company has to revise its policy related to financial management. This is called as financial control. Next function is analysis and appraisal of financial statements. The company has not only to produce the financial statement, rather than it has to analyze by taking the ratios into consideration, as well as whatever the project the company is taking into consideration, whether they are profitable one or not, that can be judged from the financial statements of the companies. Advice to top management is another area where the company, after seeing the capitalization, capital structure, financing decision, dividend, and working capital decision, all must be communicated by the financial manager to the top management for the proper running of the business. And the last managerial function is tax administration, as company has to pay corporate tax as well as various indirect taxes company needs to pay. So company has to make a balance, like company has to earn profit also, company has to make the payment of taxes also. Moreover, the company cannot pass on the benefits which the company is taking. Let's suppose if government has changed some of its policies, like in GST, the government has reduced the taxes on the necessity products. So when the taxes are reduced on the necessity of product, then the government has said that the anti-profiting measures should be taken into consideration. Means company should not make its margin high if the tax is reduced, but it is to be passed to the consumer. It is not to be passed to the consumer at high cost. So this tax administration is also one of the concern area of the finance manager or the financial management importance. So till now what we have read is the managerial functions, and now coming to the next type of function is the routine function, which the manager has to do, or the financial management we have to do, that is the cash receipts and the cash payment, or the function of this treasurer or safeguarding the cash balance. This is the routine function, and the custody and safeguard of various securities or shares, or the record keeping of the transactions, and to coordinate with the other parties, coordinate with the creditors, and to have good relations. These all are the routine functions of the financial management. Now, when we talk about the traditional finance and the modern finance, there is a lot of change in the traditional finance and the modern finance. Like prior to 1950, it was traditional finance, and now it is the modern finance. And previously, the traditional finance is the part of economics, and only the concern area is the operational activities, and the procurement and utilization funds is the episodic, means no prior planning is there. It is just like an episode that procure and utilize the fund. No further investment is the concern area. And as well as only long-term sources like equity and debt are taken into consideration, and it is the descriptive one, not analytical one. So nowadays it is completely different. That after 1950 there is a lot of change. Now it is not only a part of economics, but rather than there are so many branches of the finance, like behavioral finances there, like public finances there, and the latest contemporary area is the fintech. So, and now it is not a episodic, but it is a planned activities which are going on. And supplier's point of view is not the main concern. It is the customer point of view, which is the main concern nowadays in financial management. And angel broking firms are there to provide the funds. The major concern area is the analytical part, not only the descriptive part. So this is all about the modern finance, and there are various theories which were developed nowadays, that is like portfolio management is major area, blending of securities, investment in so many securities, and to revise that portfolio, this is the major concern which the manager now takes. So the alpha of a particular portfolio, the fund manager is judged on the basis of the alpha of its portfolio. So this is the modern function. The company take into consider how much it is levered. So the theory of leverage and option valuation, the capital structure theory, these all theories are developed in the modern function. So that is all about what finance is, what is financial management, what is the major concern area, and how the company manage the funds. Three most important decisions are the financing decision, investment decision, and dividend decision. So this is all about the finance. Thank you.